saving money in the bank is killing your wealth. You worked hard, earned your college degree, landed a solid job, and now you're trying to be smart with your money. You're paying off those student loans, covering your expenses, and diligently stashing the rest in your savings account, thinking this is your ticket to financial freedom. But what if I told you that financial powerhouses like Mark Cuban, Warren Buffett, and Kevin O'Leary steer clear of this very approach? What do they know that you don't? I'll explain in this video. But first, make sure to like, comment, share, and subscribe for more ways to invest easy. Disclaimer: all information in this video is meant for educational and entertainment purposes only. Before relying on this information, think about your situation and seek professional advice. Before making any decision, you should double-check the nature of any product or service, including its legal status and relevant regulatory requirements, and consult the relevant regulators' websites. Chapter 1: The Hidden Danger of Inflation. It all starts with understanding inflation, which is often described as the silent thief of wealth. It is the rate at which the general level of prices for goods and services rises, leading to a decrease in the purchasing power of your money. Essentially, over time, each dollar you save buys less and less. To put this into perspective, as one of the most recent data from ycharts.com, the long-term average inflation rate in the U.S. hovers around 3.28%. That means, on average, your money loses around 3% of its purchasing power each year just by sitting in a bank. Now, inflation isn't just a random figure. Instead, it's a key metric used by the U.S. Federal Reserve to gauge the health of the economy. Since 2012, the Federal Reserve has targeted a 2% inflation rate as an ideal balance to support economic growth without letting prices spiral out of control. When inflation strays too far from this target, the Federal Reserve may intervene by adjusting monetary policy, such as changing interest rates to steer it back on course. Historically, there have been periods when inflation has wreaked havoc on the economy. Take the early 1980s, for example. Inflation rate soared to a staggering 14.93%. But what does this mean for you, the average saver? It means that if you're relying on a traditional savings account to grow your wealth, you're losing money in real terms. And let me explain how. Chapter 2: The Real Rate of Return on Bank Savings. You see, the idea of saving money in a bank has been ingrained in us for generations. The thought of tucking away your hard-earned cash in a savings account feels secure and responsible. After all, the bank even pays you interest for doing so, right? But here's the reality check. That interest isn't doing nearly as much for you as you might think. To understand this better, let's break down what happens when you place your money in a typical savings account. According to a survey conducted by Bankrate on August 5, 2024, the national average yield on savings accounts in the U.S. was 0.59% annual percentage yield. This means that if you have $10,000 in a savings account, you're earning just $59 in interest over the course of a year. It's not exactly the wealth-building tool you might have hoped for. And as we discussed earlier, the current U.S. inflation rate is around 2.97. So while your savings account is earning you 0.59% in interest, inflation is simultaneously eroding the value of your money by nearly 3%. Essentially, your savings are not keeping pace with inflation, and you're losing money in real terms. That is what's known as the real rate of return, the actual return on your savings after accounting for inflation. In this case, it's not just that your money isn't growing, it's actually shrinking. If you earn 0.59% interest but inflation is at 2.97%, your real rate of return is minus 2.38%. So why do people still put their money in savings accounts? The answer lies in the perception of safety and security. Banks are seen as stable institutions, and the Federal Deposit Insurance Corporation insures deposits up to $250,000 per account holder per bank. This means that even if the bank goes under, your money is protected. This guarantee of safety is comforting, especially in uncertain economic times. However, this safety comes at the cost of lost purchasing power. So if your goal is to build real wealth, investing in stocks offers a far more compelling option than simply parking your money in a savings account. And let me explain how. Chapter 3: Why investing in stocks is a better option. You see, the S&P 500 is an index that tracks 500 of the largest publicly traded companies in the U.S. It is often considered a benchmark for the overall health of the stock market. According to a report published by Business Insider on July 19, 2024, the S&P 500 has delivered an average annual return of approximately 10.7% since its inception in 1957. This is a striking contrast to the less than 1% return offered by most savings accounts. To put this into perspective, consider the performance of the S&P 500 in recent years. In 2023, the index delivered an impressive average return of 24%. Even in 2024, with the year still ongoing, the S&P 500 has already posted an average return of around 19%. Now, imagine you invested the same $10,000 in the stock market, specifically in an S&P 500 index fund. If the market provided an average return of 10.7% per year, as it has historically, your investment would grow by $1,070 in the first year alone. Even if you factor in inflation, your real rate of return would still be significantly positive, allowing your money to grow in both nominal and real terms. But why are stocks so much more lucrative than savings accounts? The answer lies in the nature of what you're investing in. When you buy stocks, you're essentially purchasing a small piece of a company. As that company grows and becomes more profitable, the value of your shares increases. Over time, the cumulative effect of this growth can be substantial. Unlike the fixed interest rates of savings accounts, which are determined by banks and largely influenced by the Federal Reserve's monetary policy, stock prices are driven by market forces such as supply and demand, earning reports, economic indicators, and investor sentiment. This dynamic environment creates opportunities for significant gains, particularly if you invest wisely and hold your investments over the long term. Now, the question is, how do you get started in the world of stock trading? Chapter 4: Actionable Steps to Start Investing. Well, investing in the stock market might seem intimidating, especially if you're new to the concept, and you'll need to spend a lot of time understanding the market. But there is one simple approach that all investors follow. The first and most crucial step in starting your investment journey is education. Understanding the basics of investing, the different types of assets, and how the stock market works is essential. Start by learning about key concepts such as stocks, bonds, mutual funds, exchange-traded funds, ETFs, and diversification. The more informed you are, the better decisions you'll make when investing your money. The next step is to define your financial goals. Are you saving for retirement or a down payment on a house, or just looking to grow your wealth over time? Your financial goals will influence your investment strategy, including how much risk you're willing to take. And before you invest your money, make sure you have an emergency fund in place. This is a savings buffer that covers 3 to 6 months' worth of living expenses in case of unexpected financial emergencies like job loss, medical bills, or urgent home repairs. Now you are ready to start investing. Set up your investment account and develop a strategy. And keep in mind that investing is not a set-it-and-forget-it activity. You should periodically review your portfolio to ensure it still aligns with your financial goals and risk tolerance. Rebalancing your portfolio involves adjusting your investments to maintain your desired asset allocation, which might change as you approach your goals. For example, you might shift from stocks to more conservative investments like bonds as you get closer to your retirement. Now, if at any point you are unsure about making investment decisions on your own, consider consulting a financial advisor. A professional can help you develop a personalized investment strategy that aligns with your goals and risk tolerance. They can also provide guidance on tax-efficient investing, retirement planning, and other financial matters. While hiring a financial advisor comes with fees, the value of personalized advice can be well worth the cost, especially if it helps you avoid costly mistakes. Remember, the sooner you start investing, the more time your money has to grow and compound. So, don't let the fear of the unknown hold you back. The stock market offers tremendous opportunities for you if you are willing to learn and take calculated risks. That's all for today's video, and thanks for watching it. Make sure to like, comment, share, and subscribe for more ways to invest easy.